Silver price drops again. 8.7% slide shocks precious metals market. Something massive just hit the precious metals market. Silver just saw its biggest single-day fall since 2021, and gold had its sharpest drop since 2013. The question now is simple but critical. Is this the start of a crash or just a healthy correction? Let's go through what some of the top market voices are saying and break down what's really happening behind these headlines. Jim Bianco opened the discussion with this line: crash or correction? Spot silver falls as much as 8.7% in biggest drop since 2021. That single sentence captures the mood across the financial world. A fall of nearly 9% in a day isn't just volatility, it's shock-level movement. The real debate is whether we're looking at panic selling or simply a market that had run too hot and needed a reset. Next, technical strategist Axel Kibar added, 44-46 area could be the target of this pullback. Silver. This is a purely chart-based observation. Kibar is pointing to the 44-46 zone as potential support, an area where price could stabilize if the sell-off continues. It's a reminder that even sharp pullbacks can bring prices back into balance before the next leg of a trend. From the broader market view, Zero Hedge summed it up bluntly: precious metals pummeled. That headline says everything about the sentiment right now. The selling isn't limited to silver. Gold has joined the move. This often happens when global liquidity tightens, when interest rate expectations, dollar strength, or risk aversion push investors out of commodities and into cash. Heisenberg summed it up perfectly when he said, gold and silver up big, down big, up big, down big on a daily basis. These are typically characteristics of an interim top, in my humble opinion. And honestly, that's a sharp observation. When you see this kind of day-to-day whiplash, huge rallies followed by equally sharp drops, it usually tells you the market's undecided. That's often a sign we're near a temporary peak, or what Heisenberg calls an interim top. It's that moment when buyers are starting to run out of momentum and sellers are testing how strong the trend really is. In short, the market's arguing with itself. One side thinks there's more room to go up, the other saying it's time to cool off. That tug of war is what creates this volatility, and it's completely normal in high emotion phases of a rally. And then you've got Dave Collum, who added a bit of dark humor to the conversation. He said, we should rename silver Building 7. Now, that's obviously a tongue-in-cheek reference. He's joking about how unpredictable and mysterious silver's moves have become lately. What he's really pointing out is the chaos in the market. Silver's not moving like a normal commodity right now. It's spiking one moment, collapsing the next, almost as if something unseen is pushing and pulling it. Collum's comment reflects that frustration a lot of traders feel. They're watching the charts and wondering what's driving this volatility: real fundamentals or just aggressive trading behavior.
Then came an important comment from Peter Spina. The faster the paper silver players dump the price here, the faster the physical shortages will increase. Spina is pointing to the long-running tension between paper and physical silver. Futures contracts and large institutional positions can drive paper prices lower very quickly. But when that happens, physical buyers, industrial users, and long-term holders often step in. The more aggressive the paper selling, the stronger the physical demand can become later. A follow-up from Zero Hedge added more context. Spot silver falls as much as 8.7%. Spot gold falls 6.3% in the biggest one-day drop since April 2013. Gold sliding more than 6% in one session is extraordinary. The last time we saw something similar was over a decade ago. That tells us this isn't just a silver issue. It's part of a broad precious metals liquidation, possibly driven by funds de-risking or reacting to macroeconomic signals. Meanwhile, analyst Bai Xiaojun highlighted developments out of China. There has been a significant net outflow of silver vaults from both the Shanghai Gold and Futures exchanges. Multiple ETF silver funds have stopped subscriptions.
the crisis of silver vaults zeroing is getting closer. If accurate, that's serious. Net outflows mean metal is leaving vaults faster than it's coming in. When ETFs pause new share creation, it usually points to tight supply. In other words, even as prices drop on screens, the physical market may be tightening, a setup that can lead to sharp rebounds later. During Asian trading hours, James Henry observed, "Hong Kong hours silver slam again. Desperate times, desperate chart paint measures." That comment hints at timing. Many of these heavy moves are happening in lower liquidity windows, making every trade more impactful. Some traders see that as ordinary volatility, others suspect large participants might be defending key price levels. Either way, it adds to the perception that silver's trading behavior right now is anything but normal. Then Bob Coleman pointed out something seemingly contradictory. SLV ETF alert. 9.65 million shares created today, over 8.7 million ounces delivered into SLV. New high for the year in shares outstanding and silver held. So while spot prices plunge, ETF inflows surge. That means institutional investors are adding silver exposure even as the market sells off. This kind of split behavior, fear on one side, quiet accumulation on the other, often appears around turning points. Technical technician The Great Martis added a more measured take. If silver fails to push higher by this week, an ABC correction could be in place. Healthy corrections strengthen trends. He's describing a textbook corrective pattern, not a collapse, but a structured pullback that resets momentum. In that view, the market could simply be cooling off before regaining strength. Finally, Just Dario posted a controversial opinion. The BIS should really do a better job to cover its trail on these massive silver and gold slams during European hours. He's suggesting that institutional players, perhaps even central bank linked, might be active during specific trading windows. It's speculative, but it echoes a sentiment many in the metals community share, that major forces occasionally step in to dampen volatility or maintain broader financial stability. Put all of these together and a clear picture forms. Heavy paper selling shaking the markets, physical outflows from major exchanges hinting at tight supply, ETF inflows suggesting long-term confidence, and analysts split between short-term correction and long-term strength. This isn't just another routine dip. It's a moment where technical structure, global liquidity, and real-world metal demand are colliding. Whether this turns out to be a quick shakeout or the start of something bigger, one thing's certain. The silver market has once again reminded everyone just how fast sentiment can flip when paper trades meet physical reality. This video is for educational and informational purposes only. All market data, opinions, and tweets discussed are publicly available sources. This content does not contain financial advice, trading recommendations, or investment guidance. Always do your own research and consult a qualified financial professional before making any financial decisions. The views shared here are for news commentary and market education only.